Maybe board builders should be the one who captures this MEV and give it back to stakers. How massive Solana is and how amazing is that it managed to outcompete Ethereum across every metric.
There are various opinions within the team regarding MEV, whether it is good or bad, whether it is just a part of the system. I'm curious about yours. Welcome to the Deco podcast, where we bring you stories from founders and investors in Web3. Before we get started, this is not a financial or legal advice. It's just a conversation about things we find interesting in Web3. Views expressed are our own personal opinions. Deco members or guests appearing on the show may have positions on assets they talk about. All right, new episode. Today with me is Nikita Ovchinnik. He is the founder and CEO of BarterSwap. Welcome to the show, Nikita.
Thank you. Pleasure to be here. Yeah, excited for our episode about DeFi and Barter.
So yeah, I mean, before we get into topics, I want to know a little bit about you. I think whoever is watching this has probably at some point used 1inch, and you started your journey there, or how was your journey into DeFi since the beginning?
Okay, I studied at Nottingham University, and in 2013, we had a fantastic finance professor who introduced us to Bitcoin. And we studied for 2 seminars about cryptocurrencies and like blockchain. And we concluded that blockchain is an amazing technology that can be used, has a lot of use cases, but Bitcoin is bad. It's used for fraudulent transactions, the gray market, tax avoidance. We should not engage with that. So for like 3 years, I lived in a paradigm where like Bitcoin is something that I should not be a part of. And in 2017, I learned about Ethereum and like started monitor like cryptocurrency prices. And eventually I was like, okay, maybe I should start buying some coins. Maybe Bitcoin is not that bad after all. More and more institutions and projects are built on top of it. And yeah, so I got into crypto in 2017, got my first job during the ICO in one of the projects that was fundraising and then stayed there. I was working at a blockchain gaming company called the BIS, and then I joined 1inch. I joined 1inch before DeFi summer and just before pandemic in February 2020. And I was a third employee after the two co-founders, Anton and Sergey. So I was at 1inch for 2.5 years, long time. And, we grew a team from 3 people to 150. And yeah, DeFi I think was just beginning at that time, which was really great. I'm super bullish on DeFi still.
Awesome. Yeah. So before we get into it, I just want to have an outline for whoever is watching so that, if you think that the initial parts is not where you want to spend your time, you can just skip ahead chapters and whatnot. But yeah, so we really want to get to know what Barter does, what MEV is, how is Barter positioned to solve for MEV, why is it important to solve for MEV, and so on. But before that, I want to get into a little bit of what AMMs are, how are they different from order books as mechanisms of exchange? Who are the participants in both? What are the different skill sets or different types of infrastructure that you need when you are a participant in an order book based exchange versus AMM based exchange? So if you are someone who already knows this, feel free to skip this part and go to the next parts based on the chapters that you find interesting. But yeah, like to begin with, Nikita, let us talk a little bit about to my understanding, right? Back in the day, we had Ether Delta on Ethereum, which was an order books based exchange, but we realized that we need to make like gas optimizations for on-chain exchange to make it practical, right? And that is how, like, I think it was Bancor who started, like, who was the first exchange that came up with AMMs, and Uniswap kind of like championed AMMs going forward. So what are the differences in these two systems from a standpoint of gas? Why is like order book like very gas heavy compared to AMMs? And like who are the participants? And we can start there.
Right. So order books, it will never really happen in crypto on Ethereum especially. And I think we'll see a comeback. But the biggest problem is that the price of chain always moves faster. And whenever you make a quote in an order book or put up a position, you cannot just change it without paying extra gas costs. So every time the price, moves, market makers or users who open up this initial position, they would have to adjust and spend more. And they might not find counterparty and spend even more money on gas than the original position that they open. And AMMs, they are a fantastic product. The biggest difference between order book and AMMs is because AMMs work with formulas. And the first formula of Uniswap was very simple. The first formula of Bancor and Kybernetic was super straightforward. Where supply and there is a supply and demand, and you could just balance those two assets on different sides of the trade. And yeah, IMMs are much more easier to use than order books. They do not require like a constant management. And actually, if we look now, there are still some liquidities that's lying dormant on the first, versions of like Uniswap and others. Order book needs fast infrastructure, and that's why in traditional finance we have high frequency traders, and there is always a competition in order to reach orders and change orders faster in the order book. So yeah, AMMs, they were great at time. They are helping, and they have a lot of good use cases. For example, if a project has just one pool, is just bootstrapping a new coin, then AMMs that provide this infrastructure, they work perfectly. However, as projects matured and as they enter new blockchains, centralized exchanges, there is like new venues where people trade and use them. It creates a lot of arbitrage opportunities, and then AMMs become extractive. When users would abuse the price change and price difference on centralized exchanges, and AMMs would start suffer, and liquidity providers, people that deposited initial liquidities that enabled trading in the first place, they would be losing money to MEV. So to sum up, AMMs were great and are still great for some use cases. They work via formulas, and they are quite efficient for when there is just one pool for asset exists. But as assets mature and the protocol where the token is used becomes bigger, more venues emerge where it's possible to trade those tokens, especially centralized exchanges, and it opens up any. I don't know. Do you want to dive into an EV topic, or should we talk a little bit more about AMMs and order books?
Would it be fair to talk about MEV now, or you want to talk about how liquidity moves in both first and then get into MEV?
Oh, let's talk about how liquidity makes
Yeah,
big
yeah.
moves. You mean on blockchain, on
No, no, on order books versus like you will need active participants to keep changing. You'll need market makers in yeah.
All right. So since AMMs are working on a formula, so there is like different curves. So there is a specific curve for stablecoin swaps, when it's almost always 1-to-1. But in case someone is using like a lot of one type of stablecoins, it shifts and it creates a slippage. So yeah, stablecoins work with formulas, and the supply and demand are easy to predict. It's already written on a smart contract level, and you cannot quite go beyond the curve. However, it introduces other issues like LVR, for example, loss versus rebalance. When someone is making a trade on like ETH and USDC pool, the price of ETH inside this pool shifts. However, the price of ETH kind of remains the same because the price of Ethereum on other venues, on centralized exchanges, on maybe venues with deeper liquidity stays constant, and it creates an arbitrage opportunity. On order book, it doesn't happen. So I think a big, like what people need to understand, and yeah, I think this is very new, that a regular normal person comes and wants to buy asset on, doesn't matter whether it's Binance, whether it's Coinbase, or whether it's Uniswap or through an aggregator in DeFi. Regular people, they do market orders, and they receive like the best, like optimal price that exists right now, but they are initially takers of what market makers provided them the quote to them. So for them, it doesn't matter if they use AMMs or other bits. Usually for takers, the result would be relatively same. And even like often across many pairs, like DeFi might be deeper and more efficient than other bits. However, for makers or liquidity providers, it differs dramatically, because in order book, market makers are constantly providing like the flow of information. They analyze data in real time and let them adjust the price in the ways they see fit. While on AMMs, the liquidity that's being deposited inside the pool is working according to formula, and it's not easy and not as fast to extract it and adjust, the levels. So that's a big difference, I guess, for like regular users, for stakers, doesn't matter too much whether they swapped on an AMM or an order book. But order books are much more efficient for makers and they earn a lot more. Yeah. Also, order books, you began our discussion with ESO Delta, and ESO Delta was, very early and, they tested, it didn't work out. However, we did not yet see order books really taking place in DeFi ecosystem. And I think that's about to change. Actually, I'm super excited about order books for sports and for derivatives in DeFi. We've seen a couple of projects that are building. For example, one of them is an XTEM and they're backed by CyberFun, and they have off-chain order matching with on-chain settlement, which in our opinion is a good component. Another project that is just emerging, like super early. We've just seen the docs, they haven't yet the tech ready, but it's something called T plus, and they're building in a trusted execution environment. So they would have like a more transparent settlement layer, and it's also going to settle on chain, but the execution again is going to run there. So there won't be like issues like MEV, or they won't be as big as they are on other order books. So anyway, like Renegade is a good example of zero knowledge dark pool, and they'll have like an order book, I believe, that is fully working through zero knowledge ZKPs, zero knowledge proofs. Yeah, I'm super excited about order books on DeFi.
You mentioned that the order book's design allows liquidity providers to make more money. If that is the case, then why do we see liquidity providers in AMMs, and why is not everybody rushing towards order books?
So there were a lot of discussions last week on Twitter about Fluid and the efficiency and how much the users have made and the LPs. And the majority of data on June Analytics shows that they've suffered substantial losses, like few $1 million at least. So I guess the big expectation of and the big reason of liquidity provision in DeFi is expectation of tokens, expectations of future rewards that you enable a new technology with your liquidity, and then later you are rewarded with tokens, and they offset this MEV and other inefficiencies. So I guess that's one of the reasons why people provide liquidity in DeFi. I guess a lot of people are also not are more, I would say, not risk tolerant. Yeah, more risk tolerant, and they believe it's important to bootstrap projects early on, and even if they are losing some funds, and they will get compensated somehow in the long run. And historically, in crypto, it kind of made sense. A lot of projects had some flaws, but eventually, like people made more money and build more like important things with those early inefficiencies.
Okay,
Yeah.
so when a user clicks on an AMM like CowSwap or any other exchange, when a user clicks to exchange one asset for another, right, when they want to swap and they wait like 15 seconds or so and the swap is done, a lot happens in the background. And I think that is where Barter comes into the picture. That is where MEV comes into the picture. I think in Barter's existence, they have supported about more than $11 billion in volume. Correct me if I'm wrong, but that's the number. So let's get into it. But before that, I want you to clarify some terminologies that we might be using over and over, like things like solver, router, searcher, and whatever you think that we are going to use. So yeah.
Absolutely. So searchers and EV bots that try to take advantage of inefficiencies on the market and extract value through arbitrage. And there are different kind of strategies, and all usually searchers are extremely secretive about what they do. Then market makers, liquidity providers, and I think it's important to talk about market makers because they play more and like bigger role in the market right now is that we have block builders, and some block builders are run by market makers. For example, Wintermute is one of the biggest market makers in DeFi with a very big presence and a very good, very strong team. And they have rsync block builders that is part of their company. And yeah, we solvers are a mix of aggregator, market maker, and searcher. Just as an aggregator, solvers primarily route through, existing liquidity in DeFi, AMMs like Uniswap, Curve, Balancer, and others. Just as market makers, every now and then solvers use their own liquidity to settle transactions that as they see fit. And just as searchers, solvers have to always monitor, the state of Ethereum blockchain and find inefficiencies, but use them not to extract value, but to improve the rate for the user who wants to swap. So solvers are like a mix of those three things, but usually people compare solvers to market makers, and that makes sense. Like we are fine with that. However, unlike market makers, the goal of solvers and ours in particular is not to rely on our own pocket, but to build infrastructure or build products that help end users and that benefit them. That way, when we ourselves want to swap and trade, we receive the best possible price and we don't face any challenges, because like DeFi, like we are extremely bullish on DeFi. It's the best use case the crypto has, and we need to build like new financial rails on top of blockchain, and DeFi is doing exactly that. But DeFi was very difficult. People might face like high slippage and they never get back to trading again on like high gas costs. And yeah, our goal as a solver to abstract all those difficulties to make this swap process as smooth as possible and provide the best rate in addition to easiness of use.
I want to go a little bit back to how Barter started. What was the problem that you identified, and why was that particular problem important to solve?
Yeah, well, the Barter started, we were talking about like what kind of DeFi primitives are currently missing and what would be great to build. And I was always like on the lookout. I was helping advising a few stablecoin projects. I've been an angel investor in over 20 projects in crypto, like primarily in DeFi. And the topic of intents started to pick up quite heavily. And a lot of people were saying that transaction has this deterministic nature where you like encode and call data and action and you cannot quite change it. While intent is much more flexible way of expressing like your goals or desires. And yeah, like a simple intent would be I want to buy one piece. And we really like CowSwap because CowSwap has this fancy coincidence of wants topic where, like, if I want to sell one ETH and maybe one of you guys wants to buy one ETH, if we match those orders against each other, we reach equilibrium. Yeah, there is like no room for anyone else to improve. And we wanted to build a solver that does exactly that, for instance, once. And after we've done it, we realized that CowSwap doesn't have enough like volume and orders in order to make those coincidence of once orders on a regular constant basis. And we started looking into maybe cross protocol coincidence of once. So what if we go live on like Uniswap X and we match order from Uniswap X with an order from CowSwap. And we wrote a fancy Twitter thread about it. But by that time, we already had our server running for like almost 1 year. And because of this Twitter thread, we actually managed to fundraise our seed round because, it received a lot of like acknowledgement and feedback from the community. Doing this cross protocol coincidence of one sounds exciting. And, there were no room for market makers to improve the price. And it was initially like a big concern for everyone involved in our space that market makers would eventually come over and would become like the top solvers. They would, cannibalize everyone else. Algorithmic solvers like ours would fade away. But yeah, we wrote the Twitter thread, we raised our seed round, we have amazing lineup of investors we are very proud of. Maven 11, DCG, Daedalus Angel, Anagram, and a few others, all super helpful. And yeah, we wrote this Twitter thread, and now we like researched even more, and we announced a new product that we're building called Superposition. I don't know if we should dive into it right now or should we wait until later. It's your call.
Yeah. So, I mean, are there other solvers along? There are other solvers along with Barter, right? So, I want to understand a difference between an algorithmic swap solver and what you meant by market making makers as solvers.
Sure, sure. So yeah, we see different solvers. Like for example, there is a resolver on CowSwap, which is a Wintermute arm, and Wintermute has I think it's the same team that's running a solver on Uniswap under the Wintermute name. A big difference between our solver is that most of the time we route through publicly available liquidity sources. So we analyze, Uniswap pools, all those different pools, we combine them with different protocols, bridges, like wrappers around like wrap Ethereum or other assets, wrap Bitcoin, and we use like all this DeFi liquidity to settle user intent, which they specified on CowSwap, ParaSwap, Bebop, or any other interface where they are connected. So solvers like Wintermute, they see this intent and they quote a price depending on their pricing knowledge, and they settle a transaction against their own hot wallet. And that's a big difference because this hot wallet is not available to anyone else except them. And the pricing they use is usually more sophisticated because they are aware of what's happening on, centralized exchanges and other venues where they're connected, so they can predict the price movement. And sometimes they provide exceptionally good quotes that are not possible with publicly available liquidity. However, we also see that some of the rhythmic solvers go and become even more specialized in certain ways. Like, for example, some solvers would focus on meme coins, and a lot of meme coins are fee on transfer tokens. Like for us at Barter, it's a big problem because they're not standardized and every integration requires like some tinkering. But like some other solvers, it's their bread and butter. They have a lot of like orders that are tailored that they win with those meme coins on Ethereum or on Base. And yes, they do those custom integrations and they win a lot of orders because of it. So even within algorithmic solvers, there are some specialization. I think there are a few solvers that are focused only on coincidence and once, and it's also becoming more viable as CowSwap has grew in size dramatically over the last year. If you look at the landscape of DeFi swaps in 2024, in the beginning, it was, the market structure was completely different than it is now.
Okay. So, what exactly are the parameters where you compete or you are better than, say, something like Wintermute, where they have, more sophisticated understanding of pricing?
Well, usually, like the internet is very good for mainstream assets that they have in their wallet. Like usually those are some kind of blue chips of crypto. But when we talk about long tail assets, emerging assets, and also assets with a strong like online presence, more like DAOs, for example, who open up a big pools of liquidity, then solvers and anyone with access to the public liquidity to public pools, you can combine those different pools and provide a better quote. Moreover, now the gas costs on Ethereum are fairly cheap, much cheaper than it used to be in 2020 when I, started working at 1inch. It's possible to do, fancy trades and hops and, do small, it's possible to do an arbitrage that is not profitable for bots because bots pay gas themselves, but because we receive gas from users, we can improve the price for a few dollars or even a few cents of dollars via arbitrage of the pools. But the user would receive a better price than if they would use like one pool USDC against ETH, or if they would use like Binance Trade. So yeah, I think it's all about like DeFi Legos. It's about how you combine them and then do a sophisticated complex trade that benefits not bot but user.
What would be the split of volume if we bucket assets into two categories, blue chips and long tail assets? What is the rough split at Barter?
Oh, I would say it's 50-50. So we
Oh, that's
have good presence. Yeah, like we are competitive on the blue chips as well. Most of the blue chips have relatively deep pools, so we provide good term quotes on top of it. But if we look in terms of transactions, it's like that. But if you look at volume, like the volume for mainstream assets is usually bigger. So Wintermute would get more volumes than us as a solver every now and then on a daily basis.
And we also talked about MEV, right? So I want to understand how barter is, I don't know if reducing is the right word, maybe redistributing or mitigating. I don't know what the right word is, but how is barter solving for MEV?
Right. So, well, first of all, we are working with some like sophisticated solutions like MEV blocker or, Titan Builder plus one. There's also a company called Blink. And, for every trade creates an opportunity for MEV rebates and, to rebalance the pools and extract some value out of it. And we are trying to incorporate it into redistribution of those fees back to, the users, back to the traders.
Can you start with how it is generated first and then get into redistribution?
Okay, so every time a trade happens, it creates an efficiency, especially like a big trade. And then bots compete for the price to rebalance this pool, extract value out of this inefficiency, and they give it back to the protocol. CalSwap has introduced a system called MEV blocker, and we utilizing it along with a few other solutions. So MEV blocker doesn't allow like kind of third parties to extract it and gives bots that are ready to share MEV with the protocol right to arbitrage it first. And yeah, from this MEV rebates, a lot is going back to the protocol and to the users, to the users indirectly. That's one thing. Another thing is that we have a number of safety features that prevent like high slippage and prevent the sandwich attack. And let's, quickly explain sandwich attack for our users who might not be familiar with that. Whenever like I want to use a particular pool, there might be a fraudulent transaction that goes ahead of mine and uses the same pool, depletes it, and the rate becomes really bad. And then when my transaction settles and goes routes through this pool, it receives like a worse exchange rate than expected. Sometimes it can be much worse. I think there were some cases where people would use like tens of thousands of dollars due to the sandwich attacks. And there used to be a website in 2022, I remember it very well, where you can check your address and how much money did it lose due to sandwich attacks. So our solver prevents that completely. And a lot of like new aggregators, new like swap systems, for example, Bebop, which was actually incubated by Wintermute as well. It's funny how like Wintermute has such a strong dominance that they have their own like block builders, their own solvers, their own user-facing platforms, their own liquidity streaming platform. But yeah, like they all built with focus to prevent, bad case scenarios like the one I mentioned is a sandwich attack. So yeah, those are the prime ways how we protect users from MEV. Just generally nothing bad should happen to user funds and the expected outcomes that they define in the intent should be met through an auction and yeah.
All right. So for those who want to understand a little bit more, we recently wrote about MEV where we talk about the supply chain, who's doing what to mitigate it. You can probably check the article out. And I might link some resources that Barter has as well. So yeah, that was cool. Is this a good place to talk about superposition, what it does, how it helps users even more, and so on?
I think so. When we announced Superposition, we received a lot of phenomenal, like positive feedback from different teams and founders and yeah, who have building in the space. But I don't think broader like DeFi community has understand is the biggest like the value proposition. And we honestly believe it's a big breakthrough. So superposition works like it allows users not to deposit money into the pool, but always have control of their assets and at the same time made them liquid, made them connected to, those liquidity channels to, CowSwap, ParSwap, and all the other systems all at once and start to earn yield and participate in trading. And the most simple use case that we are always using as an example is a stablecoin swap. So imagine I have 1,000 USDCs that are lying idle in my wallet, not doing anything, not generating any returns. And actually, we believe majority of people might have something like that. So yeah, those assets are just lying there in case I need them. However, what if I can allow, like, can connect to Superposition and specifies that I'm happy to have like 4 different stable coins: USDC, USDT, DAI, USD1, or something like that. And I'm comfortable with all of them as long as I always have them on my wallet and they grew in numbers. And then every trade that we receive an intent from users that he wants to sell, like he wants to buy 1,000 USDC or USDT, and then we route to this user wallet, and this user received like $1,001. So their money would always grow, they would always remain in their wallet, and you can do like a lot of different complex strategies. It's possible to go beyond stable coins as well. It would be possible to mimic AMMs and have virtual pools that would work exactly as if they were like UniV3 or UniV4 or balance a pool. And it allows a lot of like flexibility in terms of users. And at the same time, only our solver would have access to those funds. And at least in the first iteration, like we are working on a second version that might be more transparent and decentralized. And then maybe we will onboard other, like routers and algorithms. But for now, like only us have access to it. And therefore there is like no NV because it's not publicly even if there would be access to other solvers, I think there would be still no or very little NEV because it's not a public liquidity in a broader sense. So yeah, this is Superposition. It allows it's a big unlock in terms of how users currently provide liquidity. I would say that PowSwap transformed the trading landscape by introducing solvers for routing and trading and aggregation. And we are transforming liquidity provision in a similar way where it becomes an intent rather than TDL. Yeah.
Okay, so users need to like pre-approve and let Barter to use their stable coins, right? Is that the prerequisite?
Yes, users would actually give infinite allowance through a smart contract to use their assets and rebalance them the way we see fit. And the rebalancing and just analytics of what kind of assets to use when will be all off chain, but we will provide as much transparency as possible. And all the settlements and the finalization of these transactions, it would happen on chain in a similar way how aggregators work.
What are the risks of like infinite approval?
Yeah, so the risks is that we become, if we amass too many approvals, we become like a honeypot, and hackers might try to find ways how to extract those money because if they somehow get access to smart contracts, yeah, they would be able to just route and use this liquidity the way they want. So yeah, there are some risks, but what's good about superposition is that they care more about velocity of assets rather than, just high TVL. So we will be restricting users and not allowing them to deposit a lot of funds. And yeah, so we don't need high TVL. We just need, we did some research and it's like a few $1 million would be enough to generate good yield and to improve efficiency and competitive of our solver swap system and to offset majority of trades from market makers that they currently win, because we're gonna do essentially what Wintermute does. But Wintermute, I don't know if we should use Wintermute, just market makers in general. Market makers tap into the hot wallet and settle trades. We're gonna do exactly that, but with not our wallet, but with wallet of broader DeFi users and DeFi community. And we're gonna do our best to make sure that they earn on every trade. There is no toxic flow, and even users themselves can build like difficult strategies to keep the assets profitable.
And by when do you think this will be like?
Oh, it's going live in 1 month. So we
Oh,
are
amazing.
extremely excited. Yes,
Amazing.
in June, end of June, we plan to start testing and we plan to release it before ECC.
Okay. So essentially, when such a swap intent emerges, you are not going to a pool to settle it, but you would rather scan the users who have already given you the permission to swap and use that liquidity instead of going to a pool which is not as efficient.
That is correct. We sort of begin to compete with AMMs, but in our opinion, it's good because AMMs need competition in order to evolve and in order to be more efficient. And unlike other, startup niches where sometimes it's all about marketing, distribution, here is pure mass. It's like Formula One. Whoever is the fastest, most efficient wins, and that's it.
Okay, so I think this is as good a place as any to talk about reliance on cow swap and other exchanges, right? Because barter comes after the user has clicked swap. They still need to go somewhere and click that button, right? So is superposition designed to reduce that reliance? What's the big here?
Yeah, we definitely want to reach out to more people and to not be dependent on just a few venues like CowSwap, ParaSwap, Uniswap X. Yes, we definitely see that if we begin to solve majority of trades on those venues, the users might say, hey, maybe we should swap there directly. And it would be more efficient in terms of gas, for sure, because the auctions that happen consume a reasonable amount of gas and house with has a number of smart contracts. Yeah, like we definitely want our users to engage with us. We jokingly call ourselves an invisible hand of the market because a lot of people might interact it with our smart contract. Actually, if you look at EtherScan, our smart contract will be in top 10 in terms of gas spending on an hourly, like daily basis. But people might not even know that they've engaged with us, that we, prevented MEV and, facilitated their trade. So, which is funny. Yeah, we are definitely working towards building our own UI, our own user base, expanding into different chains. Also, a big problem with, like, for example, with CowSwap is that CowSwap is only available on 4 chains. They are on Gnosis, Base, Arbitrum, and East Mainnet, and that's it. But a lot of people, they are always like looking for, trading opportunities across other venues, and we trying to, address it.
Oh, yeah, I think we are there. Might as well talk about Solana, right? You're talking about multiple chains. So you mentioned that ETH fees have gone down. A lot of it, I mean, part of it is due to technical improvements, etc., gas optimizations here and there, increasing the gas limit and so on. But a large chunk of the reason is also because Solana has emerged as a more than a worthy competitor, right? I mean, it is doing more volume, more transactions, generating more fees as more users than Ethereum. And it is not a flash in the pan situation. It's been something that has been consistent for the last few quarters at least. So yeah, like what is Barter's stand on this? Are you looking at Solana? What kind of an engineering effort is it if you were to, move towards that ecosystem as well?
I love how decentralized, DeFi teams are. We have so many different opinions inside our team on what should we do and what's best for the project. Like actually on every topic that exists in crypto, we all have like different views. Some people think MEV is good, it's part of the game, it's not a bug, it's a feature. Some people are very radical and saying that we should eradicate MEV completely and that it should be solved on a network level, not on a project level. So same about Solana. We have like big fans and people who think that we should really, really go there right now. And I actually feel that majority of people, especially on Ethereum in the Ethereum ecosystem, still don't understand how massive Solana is and how amazing is that it managed to outcompete Ethereum across every metric. We have a big research team as part of Barter who is responsible for mass analysis and all the features, all the products we built. And we were in Dubai for Token 2049 conference, and we talked with a few data providers. Like we talked with Nansen team, and they are really impressed by Solana metrics and user activity. And for us, that's great because we always, as a solver, we're kind of tied to EVM chains. But now superposition is something completely new for like DeFi and for any chain. And if we decide to go to the Solana route, I think it would be nice and value it would generate a lot of value for their ecosystem, and we can get some good solid partnership, good brand awareness. We are considering participating in a hackathon. Actually, one of the reasons why I think Solana is so successful is they have a very good, strong vertical of what projects need to do in order to gain spotlight on Solana. So they have this Coliseum hacks. They have super teams, and super teams are pushing you for you and providing guidance and referrals, and just engage with projects on a daily basis. And I think it's what was missing from Ethereum, because imagine projects like OneInch, they started on a hackathon, and I think the ecosystem was smaller and everyone was more willing to help each other, and everyone kind of like knew each other. But now, when it became bigger, it became a little bit chaotic. And now, for example, Barter, we've facilitated 11 billion volume. Our smart contract is a top 10 Ethereum as a gas spender. And at the same time, we've never had kind of any direct engagement, communication, or like being part of, some activities that are happening within the Ethereum ecosystem, just because it's hard to reach and hard to engage with them. So yeah, this is one of the issues that the EVM chains Ethereum ecosystem has right now. However, yeah, Solana is doing great in that terms. So yeah, like we are actively evaluating. At first, we are definitely gonna go live on East Mainnet, and then we will probably hit a few L2s which are faster, just to verify how solution works with faster, block times, faster transaction settlement, and maybe then we will be ready for Solana.
Yeah, that's fair. And probably maybe the only way to go about it, I don't know. You need to try on faster chains which are EVM compatible and then think about Solana. Fair enough. So Barter has about $11 billion in volume. Is there a fixed percentage that you charge, or does that vary trade per trade?
Yeah, we are quite open about just the revenue streams and everything. We are quoting 1 basis points on the stable swaps, so it's like a tiny portion, and up to 3 basis points, actually usually less for the rest of the assets. But I would say solving business is not as profitable as many people think or expect. And also there are, I would say, even like different types of solvers. So there are solvers that are doing cross-chain swaps, and it's more about, inventory management and facilitating, like bridging assets from one chain to another. And there are algorithmic solvers within one chain like ours. So I'm not sure about financials of cross-chain solvers. Like I hear different stories, and we probably need to engage with someone to find out exact what's happening there. But for us, like out of the like 11 billion volumes that we processed, we generated approximately $1 million of revenue, and almost half of it is in the form of cow tokens. So it's like heavily dependent on cow token price and token emissions and token rewards to solvers. So yeah, those are the economics. It actually doesn't look great when you talk to investors, because all investors want to create like DeFi startups, 100 like $1 million businesses. And in order to do that, we would need to process like trillions and
Trillions
trillions
in.
of yeah, that reaching like crazy numbers, which probably not happening anytime soon. But yeah, we are evolving. We are offering the superposition, and that's gonna be like a new way of hopefully providing liquidity in DeFi. Hopefully, the most competitive liquidity source in DeFi, and then we can maybe charge more. But in the first like 6 months, we don't plan to do it. We just plan to focus on adoption, awareness, and efficiency.
Right. You also mentioned that there are various opinions within the team regarding MEV, whether it is good or bad, whether it should be eradicated, whether it is just a part of the system. I'm curious about yours.
Oh, mine. No, I really dislike MEV. I think we cannot have like build NASDAQ or new financial rails when MEV is present. And we don't need for an invisible kind of the market via bots to balance it out. Yeah, it's possible that maybe MEV is to blame for these problems right now. It's like, bleach from like 1,000 cuts or something like that. Yeah, it's a famous quote. So, in my opinion, MEV is bad, and we should somehow move away from it and just eradicate it on a network level.
But what are the ways to do that? Is there a way to do it?
Truth to be told, I don't know. I hope, guys like Flashbots and other teams that are heavily focused on this particular problem will find a solution, and we will live happily ever after.
But TradFi's solution to this was dark pools where, brokers, etc., and, bunch of investment banks. And that is not working out very well for them, right? Isn't it?
It's not. Yeah.
So, I mean, if traditional markets, and that is MEV essentially, right? I mean, bad pricing as to end user is a form of MEV, right? So, yeah, I mean, I just wonder how we can solve it at a network level. And that would be quite a breakthrough, right? Something that traditional finance couldn't do for the last, God knows, like 150 years. To do that, like using blockchains, could be something cool.
I don't know, maybe block builders. Maybe block builders should be the one who captures this MEV and give it back to stakers. Honestly, I think there are like a lot of approaches. It's just I wouldn't leave it out to bots, and I think a little bit of centralization on the MEV landscape would not harm the system in general. Like yeah. It just and it would help to avoid a lot of scenarios where like the captured MEV was related to some kind of fraud or theft, and that this money would be sent back to the victims rather than like arbitraged by bots, and then it would be impossible to trace them.
But aren't bots currently giving up a large chunk of it to a block builder in the form of fee?
They do, but not as big as people anticipate. And what's funny is that Solana kind of has the same problems with tipping via bots. So yeah, bots do tip, but not as much. And maybe since the bots are tipping already a significant amount, we just move this part of work to block builders.
Right. I mean, if there is more and more competition among bots to capture it, which would mean that in order for them to get into a block, they will have to pass on more and more percentage of what they have earned through an EV to block builders. Right. So I don't know if that is something that we are working towards.
Yeah, it's a very complex problem for sure. And like, I think Ethereum has been trying to solve it for almost 5 years at least, like since DeFi emerged. And the fact that we haven't yet found ways to do it in an optimal way, like, speaks for itself. But like, if we want to have more users, we definitely should minimize it more than it is today.
All right. I think that is all the stuff that I had. In case I have missed out or anything, please let me know.
No, I loved our discussion. Thank you so much. I hope our listeners enjoy it as well.
Thanks for the time. I had fun as well. Thank you so much for the time.
Thank you and have a good day. Bye bye, everyone.